Hi everybody, welcome to the NCI TABMA webinar, and today's session is with myself from NCI and Jeff George from Head of Compliance and Claims at NCI, and we're going to cover off we sold the goods, now let's get paid. We're going to touch on collection of monies, new collection systems via SMS, and they'll be relatively quick. We'll just touch on some of those areas. Best times to phone to start collecting your money, or at least put it out there that there are a few options. And then Jeff's going to talk about the preference situations. So this is number 4, it's the final one in the webinar series. And with that, we'll start on today's slide, on the first slide, sorry. Collection of monies. So in doing the research for this, one of the things that I came across that I thought would be appropriate to share is the liquidators list the major one cause of business failure is poor cash flow management. So of all the companies that fail, that is the number 1 item. And being in credit, one of the major things that credit managers and business owners can impact on is making sure that that cash flow is collected as soon as possible. It's possible to have paper profits, but you can still have problems if there's insufficient cash to pay your creditors. I guess it's not all just about that. There are other reasons for cash flow. There's a significant increase in stock, inadequate credit control, increase in the debtor days, incurring bad debts, poor accounting practices, including late invoicing, and inaccurate forecasting, failure to plan for capital and/or exceptional expenses. So they were, according to the reports that I was reading, they were some of the key issues that affect cash flow. So one of the beauties of being in a role like I have is that you are continuously meeting new business owners and credit departments, and I guess over 28 years I've met many. Some of them are particularly good, and some of them, as you can imagine, are rather slack or lax in their approach to collecting money. The options that I've seen, and when I was a credit manager, the standard procedure was that we would wait and start chasing money when it was about 7 days over, and at 45 days we'd look at maybe stopping the credit. But I've had the pleasure to work with a number of companies where they do things very differently. So I just thought it'd be appropriate to share some of those. It may not suit your business, but it's certainly food for thought. So we have a few clients that decide that they want to collect the money spot on the 30 days, like we all would. And building construction, which is what TABMA members are associated with, the standard would be, I would expect, 45-day payments, and some of them going out to 60 days as normal practice. But I've seen a few building suppliers take a different approach, and they start talking to their key accounts 7 days before the end of the month, before the account's actually due for payment. And the telephone call goes along the lines of, as you'd be aware, your account's due for payments at the end of this month. We just wanted to make sure that everything was in order, that you had all the invoices, and for our budgeting purposes, we could rely on, for our cash flow projections, we could rely on the account being paid on the due date. When they first started to introduce that, there was a little bit of a, well, it's not due yet, and a bit of negativity towards it. But after about 6 months, it became the standard, and there was no objections. And in fact, that particular business, or one of those businesses that I'm referring to, acquired a second business, and they claim that they did so without requiring bank funding, purely because they changed the success of their collections and they funded it out of the extra cash flow that we've generated. We have other clients who, on the 30th day of the month, decide that that is the day when everybody should have paid, and depending on the business, if it's not paid within 7 days, they'll be on stop, or 45 days, or whatever. But it's interesting to know that there are a number of different attitudes and a different set of options, but the bulk of them would be, we experience, is that people start chasing the money at 7 days, put them on stop at 45, some, depending if it's a key client or something like that, at 60 days. But you can chase the money or confirm that the money is about to be paid before the account becomes due, just to make sure there are no queries and no disputes. The impacts that we've seen, I've really covered that off. It was more about the client of ours that funded another business through the improvements in cash flow. Actions of collecting money. Well, obviously with technology these days, things are changing. So it used to be standard letters and telephone calls, and a lot of that still exists today, of course. But we see more technology coming in. We have a partnership arrangement with a company called ILDM, who, for example, is one of a number of businesses where a client can load on their aged debtors and have certain parameters, rather than tying up staff to actually chase and pick up the phone. An SMS will go to an owner, a builder, or whoever it is, reminding them that their account is now overdue and payment is required by return, or within 24 hours or 48 hours, or however way you want to structure it. But certainly the new technology is here, but I think it's being quite slowly introduced. We have other clients who use their sales reps in the field to visit key clients, the ones where they have larger balances, to just make sure that the payment is being made in accordance with their payment terms. So those are really the key issues that I wanted to touch on today with regards to the basics of collecting money. We do have the box there is if anybody has any questions that they'd like us to address at the end of the session. And now I'd like to introduce Jeff George to talk about preferences. But I just wanted, before we go into that, just wanted to touch on the principle of why preferences were, the laws around preferences were introduced. And I think that the principle of it to start with was very solid, and it was well-meaning. If a company goes broke, into liquidation or whatever, the legislation, from my understanding, was introduced to make sure that family members and friends wouldn't be paid in preference to other suppliers. Unfortunately, the way that the legislation has been drafted has meant that liquidators and administrators now use the law of preference, not for the benefit of unsecured creditors, but actually as a source of collecting income that then goes to paying the liquidator or the receiver's fees. Monies from preferences rarely gets distributed by an increased dividend to unsecured creditors. So with that, I'd like to introduce Jeff George. And Jeff has had a large amount of experience with our clients, going through the painful experience of doing normal course of business, prompt collecting the money, and then 6 months or 3 months after the company's gone broke, receiving a letter demanding a refund of 100, 200, and we've even had preference claims of over $1 million. So with that, I'd like to introduce Jeff George.
Thanks very much, Terry, and welcome everybody. Preference claims. I think it's fair to say they are the bugbear of any credit manager's existence. A credit manager, it seems to be the more diligent you are in collecting your money, the more susceptible you may be to a liquidator's claim. I oversee the claim side of the operation, and I do see a lot of preference claims that that come through to us. I'll start with the first slide as to what are unfair preference claims. Fair or unfair? As I've said, a lot of credit managers out there think they are very unfair. The definition is precisely as the name suggests there. They're payments that give a creditor an advantage over other creditors. Liquidators appointed to companies can recover such unfair preferences to distribute equally among the creditors. But as Terry alluded to, does that really happen? Is it just a tactic to line the liquidators' pockets with fees that they may be trailing on? Are they just? Is it just a fishing expedition to see what is out there, to see whether there are some susceptible creditors that will just repay the monies back? Very seldom can I say that happens. They're sometimes called voidable transactions as well. It is law. It does form part of the Corporations Act, but it is a bane of any credit manager's existence. I'll then talk about the elements of an unfair preference claim. What constitutes a preference? Firstly, the transaction needs to have been entered between the creditor and the company, so there needs to be a debtor-creditor relationship. I often get asked whether cash sales can be incorporated into a preference claim. That is not the case. Cash trading is excluded because there's no debtor-creditor relationship on such trade. Secondly, the payments need to have come in between what they call the relation back day period. The relation back period is 6 months before the date of insolvency or from the date of the winding up application. So any payments that you as a creditor have received in the 6 months before a debtor falls over are potentially susceptible to a claim from a liquidator for refund. Thirdly, it must be an unsecured debt. I'll talk about the value of having some security over your supply later. And fourthly, the company was insolvent at the time the payments were received. And fifthly, the creditor received a better return than it would have otherwise received. Cannot highlight enough here that the burden of proof is always on the liquidator to prove those very elements that I've just described. Liquidators have a statute in which they need to commence an action against a creditor to claw back preferences. They've got up to 3 years in Australia and 2 years in New Zealand. And from recent experience, I have seen liquidators use that statute that's available to them, and you think you've got away with it, and then very much close to the 3-year mark, there's demands that are served and actions that are commenced against creditors to refund preferences. That happened with Harris Scarfe here in Adelaide many years ago. The defences that are available to you, the heartening thing here that there are defences that are available. Very seldom do preference demands go the distance. By that I mean go to court. They are often resolved by negotiated commercial settlements because I think liquidators do see that there are weaknesses on their side and probably vice versa. So they're often resolved by negotiation, often at a pittance of the amount that a liquidator might be looking to claim. Generally 30% I've seen, sometimes lower, depends on the case. First defence that's available is the good faith defence, a notoriously difficult one to prove. A liquidator needs to show that the creditor became a party to the transaction in good faith. The creditor had no reasonable grounds to suspect insolvency, and a reasonable person would have no grounds to suspect insolvency. The key word here is suspect. So any sort of suspicion that a debtor may be trading whilst insolvent is grounds for to quash a good faith defence. But we often see, how can a creditor know exactly what the trading position is like of that debtor company? They're not seeing their financials in the 6 months before their demise. So how are they to know that they are trading whilst insolvent? The running account is also a defence that's available on a preference. It's where there's an ongoing business relationship between the debtor and the creditor, so there's some trading history there. And what's looked at is the difference between the maximum or the peak indebtedness in that relation back period. So in the last 6 months, what was the highest amount that you are owed? And then they look at the amount that you are owed at the date of insolvency. And there is, that's what they call a running account, and is a valuable way in which to reduce the preference claim against you. The secured creditor defence, remembering that any preference must be unsecured if you have secured your interests by way of registering on the PPS. So you've sold your goods subject to retention of title and you've perfected that on the PPS register. Anything there helps with the secured creditor defence. Goods that are in the possession of the insolvent company can be excluded. The set-off defence. This is where it can reduce a liquidator's claim by the amount owed as at the date of insolvency, and that can be offset against the liquidator's claim. It can only occur when you're owed more than the actual preference claim, and the creditor did not have notice of the company's insolvency. It's a controversial and heavily criticised defence. It was used in a case probably 4 or 5 years ago now in Queensland, Rexel versus Morton. It often gets quoted by lawyers who are acting for creditors to reduce and minimise the amount or avoid the preference altogether. So as a credit manager, what do you need to watch out for in potentially leaving yourself open to a claim for a preference? It's those situations where a debtor might enter into a payment arrangement or an instalment plan that's outside of your normal trading terms, where lump sums may be received in round numbered payments that aren't connected to a particular invoice, payments that come into you after you've referred the debt for collection or you've commenced legal proceedings, or payments that are made after you've threatened to stop supply or supply has stopped. So how can you avoid them? Well, it's not always easy. As I said, the more diligent you are as a credit manager, and at the end of the day, you're doing your job to get money in, potentially the more susceptible you are. If you're keeping good notes, if there's paper trails there internally where you're chasing a debtor for payment, they're potentially discoverable down the track, and it can weaken your position. So it's very much and that's why it's a bugbear of any credit manager's existence, really, because it's very contradictory in a lot of ways. The more diligent you are in collecting debt, the more susceptible you can be to a preference. Where I say contradictory is your policy that you have with any insurer, including QBE. You need to use your best endeavours to avoid or minimise loss, and that includes getting the money in, entering the repayment plans, performing your credit management, credit control, where you're passing debts for collection at a certain point when they're unpaid. But as I say, it's always better to get the money in and to have the fight later. There's certainly defences that are available to you. What to do if you receive a demand to refund preferences? Consultation is important here. It's important that you tell us about it. We'd like to notify QBE. There is a preference claims endorsement on your policy. Even if you think it is a fishing expedition, it's not a genuine request from a liquidator. There are, I mean, often we hear that I'm just going to ignore this first demand. We think it is a furphy, it won't be pursued. From my experience, they tend to be pursued. There'll be a second letter that comes to you. The liquidator will then engage a lawyer to act for you. Our suggestion is to always get on the front foot when a demand is issued to you. Reiterate again that the burden of proof is always on the liquidator to prove their claim. I think specialist legal advice I talk about here, it is a very complex area of the law. We have a number of legal providers on NCI's panel that are specialists in this area that can assist in avoiding the claim altogether or reducing it, minimising it significantly. I think it's important that the liquidator knows sooner rather than later that they're going to have a fight on their hand if they are intending to pursue the claim. It's important that you use your best endeavours to avoid or minimise that demand that's on you. Hence my suggestion that we get a legal specialist in your corner to assist. It's important that we're consulting with QBE right through the process and get their approval before any settlement is made based on legal advice you're receiving. And I mentioned that the majority are definitely resolved by negotiation, and that it really depends on the merits of the claim from the liquidator. All cases are different. How strong your case is against them. I'd be happy to answer any questions. Are there any questions from the group? Okay, no questions there. I think the key message to take out of the preference claims is to know that the insurer, on one hand, wants you to use your best endeavours to avoid minimised loss. So you're doing that by pursuing payments where you can, including those in the last 6 months before a debtor falls over. And there is then that clause on the policy where an insurer can assist. Can the preference defences be used in conjunction with one another? Absolutely can. The defences of good faith, running account, secured creditor, set off, they can all be used together if and specialists, legal specialists in this field will do that. They will certainly respond back to a liquidator with any and all available defences that you have. Hence the suggestion to really get a good legal specialist in your corner to fight the good fight for you. Okay, thanks, folks, for listening. I will pass back to Terry Duffy to conclude today's webinar.
Thanks, Jeff. That was quite informative. I'd just like to add the issue there with regards to using a proper legal advisor is very, very important. We've seen solicitors that have a relationship with a client of ours who does their property leases and all other sorts of general thing, be asked to defend the preference matter, and they've ended up settling at tens of thousands of dollars above what they should have done, or even shouldn't have actually had to settle at all. But it's a very specialized area, and unless you actually know what you're doing in regards to defending preferences, you're open to all sorts of potential problems. So with that, that concludes our series of 4 webinars. I'd like to thank TABMAR and the team for the opportunity to present it, and for their foresight in creating such a webinar series. And with that, I'd like to wish you all a good day. And if you have any further questions on an ongoing basis, you can contact us at any time or contact us through TABMAR. So with that, we'll conclude the webinar series on credit. Thank you.